For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future.
Why, yes. Welcome back to the podcast. Hey, here's the big question today. All right off the bat, should you own more stocks in retirement or fewer stocks in retirement? I'm Johnny Dean, your podcast host, Professor Rick Plum, certified financial planner professional, and accredited wealth management advisor. That question, by the way, it sounds like it's begging for this rule of thumb answer, you know?
And, when you ask a question like that, didn't we talk about this last week or the week before?
Yes.
My answer is going to be, it depends. I mean, come on.
We talked last week about rules and guidelines, science versus art. It was a great discussion. We've had some good feedback on that. But now I throw out a question like this, and it's one, Rick, this is a question we've gotten, probably a couple dozen times over the 25, 30 years, both on the show and in our in-person seminars that we did like 3 decades ago. Now, okay, so if somebody asked that in a workshop back then, what do you think your most common answer to that question would be before we go into detail?
After I said it depends, I would say from a financial standpoint, keeping emotion out of it, you can afford to be higher percentage in stocks at an older age than at retirement. And the reality is, the day you retire should be the lowest portion of stock in your portfolio that you have. Mm-hmm. That should be your low point. That's the day you retire, because that's the day you have the longest retirement ahead of you. The day you retire is the day you have the longest retirement ahead of you, and you have to make your portfolio last for that period of time. Now, typical 65-ish retirement, take it out to 95. At 95, do you have to provide for 30 years worth of retirement income? Probably not. I'm just guessing here. And reality is, much of the portfolio you have left at retirement, assuming you have more than enough for the next 3-4 years, is kind of being invested for your heirs, not for you. So you say, well, I'm not going to have expenses 3 or 4 years when I'm 105 already. Right. So who are you investing this money for? You or your heirs? At that point, you're investing for your heirs. Financially, you can have more stocks as you get older because of that shorter payout period available.
Well, this isn't talked about a lot. What you just said isn't talked about a lot. And I want to explore this topic today because the generic answer is usually that you should own fewer stocks as you get further into retirement, the quote-unquote logic being that owning stocks is risky, and the last thing you need at age 85 or 90 or whatever it is to be exposed to huge amounts of financial risk. That's the generic stock answer. But in fact,
wait a minute, you just made a comment that is wrong. I'm sorry. You said due to the financial risk.
Well, yes, I was getting to that.
Owning stocks is not risk. Owning them in inappropriate time horizons can turn what we know the stock market is volatility into risk.
Well, see, I was building up to something. But,
I'm sorry.
That's where
I was building up to. I heard a wrong statement. I couldn't let it go.
Yeah. So, that's the idea that risk is
equal to volatility.
Right. And we have said this many times that risk is not volatility.
But don't we just take 100 minus our age and it tells us what our stock portion is supposed to be? We don't have to think about it. It's done for us. The rule has been set.
Oh, rule. Well, the risk of stocks only occurs when you have to sell it at a loss in order to fund a short-term need. Or maybe you panic and you're afraid the money won't be there when you need it, which is for a short-term need. But that's why I want to talk about this. Now, one of the things, there's a big industry devoted to the whole idea that stocks are risky, and I'll put that in quotes for you, that stocks are risky and you shouldn't own more stocks as you get older. You should own fewer. And that manifests itself, Rick, in the form of target date funds.
Oh, gosh. Going to get me started on target dates?
Well, should I? Because I'm trying to answer
this. It goes back to the rule of 100. It's a rule. You should have less stocks as you get older. And everybody who has a specific target date, 2030, 2035, 2040, has exactly the same needs, same risk temperament, same goals, same everything. Nobody's different. Everybody's the same that has that time frame. And then trying to actually understand target. Now, target date funds, and this is like the age 100 minus your age, or the idea that you get fewer stocks as you get older. On the surface, it feels good. It makes sense. It rings like, oh, yeah, that kind of makes sense. I like that. Does it really work? No, but that's an issue that we'll get to in a minute. But it's all this, the target date fund. We have a one-stop shop. Everybody can take care of it. You're taking care of it, all done. Now try to figure out what the hell that target date fund is doing. It's a whole different game. And unfortunately, what a target date fund does is it takes away what the markets will give us. And it then subjects us to what the markets do to us after the fact, because they treat it the same. Now, when I am saving and accumulating money for retirement, the idea is that as you get closer to retirement, you want to have fewer stocks. And it goes right along with what I said earlier. The lowest point of stock ownership in your portfolio should be right at retirement. So a target date moves towards a lower percentage. And the reality is a bucket strategy is going to do the same thing. As we get closer to retirement, we start filling bucket number 2. We start filling bucket number 1 when we start getting very close to retirement. So as a percentage, our stock percentage goes down just before we get to retirement. So it looks like we're somewhat mimicking what a target date fund's, or they're mimicking what we're doing. It doesn't matter which way. The problem is they're taking all the contributions that you're putting into the fund and allocating them across their allocation. If it's a 60-40, 50-50, 40-60, that some percentage of your contribution is going into the safety side and some percentage is going to the stocks. You're not taking advantage of the true volatility of the market. And the volatility of the market is what helps us save for retirement, helps us grow for retirement, helps us build for retirement by buying things when they're on sale. And it screws up my ability to use the market for my advantage. And then when I do retire, we have to then start taking money out of the portfolio. It subjects me to that volatility because now I'm taking money out and they're taking it out pro rata. It hurts me. So it doesn't help me going in and it hurts me coming out. So it screws up everything I'm trying to accomplish. And that's before you even get into the idea of, do you actually understand what your target date fund is doing? Is your target date fund a target to or a target through retirement? And what happens when you get past your target date? I wanted to have a 2025. What's happening to my target date 2025 fund? Well, that depends. Was it a to or through? And what point does it actually how much in stocks do I have? I was earlier looking at some target date funds, and I was looking at 2025 funds. Okay, unless you can go back in time, that has already passed. So that date has already passed. One of the fund families, very good, these are all big fund families, I'm not going to say names, was 50% stock, 50% bonds at that time. Another one was 40% stocks and 60% bonds. So they all have different opinions on what your target allocation should be at that specific target date. And then it's like, okay, so what am I doing? And then it goes through and now it subjects yourself to reverse dollar cost averaging, sequence of returns, and all the negativity and it takes the volatility of the market and turns it into risk.
Well,
I don't
so
like
what
that.
you're saying? No. Well, not at that age. So, yeah, we really don't want risk at any age.
I don't want risk. I try to minimize risk where I can. I've done stupid things enough. I need to get away from risk. But with saving, I don't see the market volatility as risk when you're 25, 35, 45, or even 55, and you've got retirement ahead of you 10 years or more. That's not risk. That's just volatility. That's, again, using what the markets are giving us to our advantage. Risk is having to sell, either because I emotionally can't handle it or I financially need the money to spend. Having to sell when the market is down, turning a temporary paper loss into a permanent real dollar loss sucks. And we want to avoid that.
You're talking about now. Just to sum this up, because I knew when I used the word target date funds, the phrase target date funds,
you're going to set me off.
Yes, and we only have we have a limited amount of time on the podcast, but that's good. That's good. I like that. I love ranting and raving. I think it's fantastic. But when we talk about target date funds, for those that don't know, they should just very quickly. The idea is to start with a higher percentage of stocks, maybe when you're young and you got a 30-year, so a 20-55.
A 2060 would probably have 5% bonds, 95% stocks.
Right.
And I fault at 5% in that respect, because a 2060 fund should be 100% stocks.
Right. So that's the idea. But as you get closer to retirement, that ratio starts to reverse a little bit, and then next thing you know, you have at retirement 40% stocks, 60%, whatever it happens to be. So that's the target date fund, and I'm talking about this, and you're mentioning dollar cost averaging into it because so many 401k plans have the target date fund option. It's just
that's where they were designed for.
Yeah, for 401k, and you said your problem is, well, your dollar cost averaging, in a 401k, which means that you're putting money throughout the target date fund. So you're dollar cost averaging into something that has no volatility or little volatility. And that doesn't help you when you're saving. And then when you go to take money out, now you've got the problem of reverse dollar cost averaging. I don't want this to get too technical, but we've talked about this many times. So Rick, you have a problem with the target date fund just from the very structure of it, right?
Yes and no. I have a problem with it not being as efficient on the saving side and subjecting myself to actual risk on the withdrawal side. That doesn't mean I can't potentially use a target date fund to somebody's advantage, especially if the majority of their money is in a 401k. It's just a matter of don't use it blindly. Don't use it as the only thing. And, if you're getting ready to retire, you can use a target date fund. It's basically a balanced portfolio, and you can use it as your bucket number 2, and even though it's going to change slightly over the next 5 to 7, 8, 10 years. You just have to know what's there and know how to use it to your advantage. Don't just use it for 100% of the portfolio. I will use a target date fund as a bucket number 2. I am not contributing money to bucket number 2. I'm taking existing assets and putting them into bucket number 2 and letting them sit until they need to be used to fill bucket number 1. But so I can use a target date fund. But everything has, these are all financial tools. And whether it be annuities, oh my gosh, I used the A word, target date funds, they all have a potential use, not for everybody, but for some people, used correctly and used appropriately. But that means that you have to understand what they are. Used correctly and appropriately, you can get a desired outcome. Used carte blanche for everything, or just without knowing what you're doing, you're probably going to screw yourself up.
And unfortunately, that's the way I think many, if not most, people use some of these tools. So to bring it back to my original question, which was, of course, I forgot.
Oh yeah,
no,
how much stock? Well, that's the problem with target date funds. If you want to go that way, once a target date fund gets down to a certain level, whether it's target to or through, even target through funds will hit a certain level and stop changing at some point, and it will maintain that lower portion of stocks, usually around 70% stocks, 70% bonds, 30% stocks, or maybe 20% stock. And it'll maintain that for the rest of the individual's life. And so you're 90 years old and you've got a 20-80, or 70 or 30-70 mix when you really don't need to be that conservative.
Okay, so let's take it that way now. We're of course not looking for a number. What percentage of stocks? That would be crazy. But should you own fewer stocks or more stocks in retirement? Is a little broader question. So the idea, as we said, with the target date fund is that they will decrease your exposure to stocks because of the apparent risk. We have kind of debunked that of owning stocks in retirement. I'm going to throw this scenario out, and you tell me if you think that this could apply to many people, if not most, could apply. And that is, as you said, let's decrease the amount of stocks that you own right up to, let's say, age 65 when you're going to retire. And at age 65, you are at the lowest point of stocks.
Percentage ownership.
Yes. Your percentage of stock ownership is at its lowest point. But from there on, over the next 10, 20, say 30 years, the percentage of stocks that somebody owns actually goes up.
Well, it can and probably should.
Well, that's what I'm asking you, because that's what I said. This scenario, is this a scenario that you would have a problem with in general? I hate to say in general because everybody's different, but
and I won't answer a general question like that.
No.
And I think part of this comes down to what all the rules that we're talking about now are rules of thumb, are that your ownership of stocks is the focus factor. How much you should have in stocks is our first primary, and then the rest goes into bonds. That's wrong. When you're retired, when you're getting ready to retire, when you're through retirement, how much you have in stocks is a byproduct of how much you have in fixed income safe assets. How much you have in safe assets is the driving portion. How much should I have in safe assets to provide the cash flow that I need for the next 15 years or so, 10, 15 years? And then once I have my cash flow for the next, call it 15 years set, the rest of it can be in stocks. Now, if I'm 95, I might not need 15 years worth of cash flow. So I need 5 or 6 years of cash flow, and then the rest can be in stocks. So we're looking at it the wrong way. We're looking at how much can I have in stocks, or should I have in stocks, and then I'll put the rest in bonds. No. It's how much should I have in fixed income safety fixed bonds, and then the rest goes in stock. I need to support my cash flow. Primary focus, cash flow. Once I've got cash flow satisfied, now I know that I can afford to have the rest of the money in stocks and go from there.
You've resolved this earlier than usual in the podcast. That's
okay,
exactly.
Well, go get some lunch or something.
That's exactly where I was going. This is you've just asked the exact question that almost nobody asks, but needs to be asked. But they need to ask, which is not how much in stock should I have, what percentage. It's how much safety or non-volatile assets should I own? And there can be a number for each individual. We can come up with that. And then whatever's left over can go into the stock portion, is what you're saying.
And that's one of the beauties of buckets, because the buckets will outline how much you can afford to put at, I'm using this term loosely, risk. How much you can afford to have in a volatile environment. It doesn't say you need this, therefore you can only have 20% in bonds. No, it says I need something. Now, and this goes for any age. It doesn't even talk about retirement. You're 25, you're just first starting out. You don't have credit cards, you don't have any. You need to have some cash on the sidelines for emergencies. So your first $50 that you save, $100, is not going to the stock market. It should be in a bank account so that you can withstand the rent payment that's coming due in a month. But as you've got the availability of emergency money, get away from me money. Now, what do you need? You are, assuming your job is fairly safe, you are bucket number one, and technically you're bucket number two. So that way, now we can afford to put the rest of these new contributions into the stock market because we have a long-term time horizon for it. But we're always evaluating when will I need to spend this money? When might I need to spend it? And if you're talking emergencies, how are you going to cover that emergency? For many years, my emergency fund was a paid-off credit card that I could hit because I wanted the growth, and I didn't want money sitting in a very low interest rate environment. And emergencies may or may not happen. And so I'd rather, if it happened, then I would, buy myself some time with the credit card and figure out how to pay it off after the fact. If it was a bad time in the market, well, I'd suffer. That's the risk I was willing to take, either by holding on and paying a high interest rate or whatever. But it's a matter of evaluating cash flow. In every one of these little aspects I've been talking about, I'm evaluating cash flow. When am I going to need cash? How am I going to need cash? And if I need cash, where is it going to come from? Because it should not come, if I have an immediate need for cash, a not too distant future need for cash, it should not come from the stock market unless I'm taking an opportunistic view of it. I know I've got it covered in a pessimistic view, downside volatility, but in an upside volatility, if I want it, I can always strategically value average and take it from the stock market. If the market's in my favor, and I don't want to spend my cash right now. The market's up 30%. making these numbers up, by the way. I'm not saying the market's up 30%.
It's not.
It's like I'll use some of that cream from the top of the crop over there, and instead of and I've noticed this as I got older, I cherish my cash.
You and me both. It's funny because we talked about
used to, but I do now.
No. That's kind of the funny thing too, because we've talked about this for so long, and I was in my late 20s and you're in your early 30s, whatever, when we first started talking about this stuff, and for us it was all in the future. It was a theory, but as it approaches, you say, man, that's
attitudes
I was right.
change.
It sure does. It does, because you're actually in this scenario now. You are not going to say that there is. We use the term risk loosely, and when you say put it at risk, like you said,
put it
that
in
means
volatility.
Yeah, I almost hate to say put it at risk, but
I know.
But let me say this. I want to be clear. I would not get you to say that even after 15 years, there is no risk in stocks. Historically, you've been okay, but what would you say about that?
Well, there are arguments to be made that in a typical buckets plan, we're spending bucket 1 over 7 years, spending bucket number 2 over 8 years. And if for some reason you never wanted to value average, and now you're in the 16th year and the only thing you have is 100% stocks, that you're still okay. Because if we look at the amount of cash flow, and if we're looking at taking a 4% withdrawal, whatever the case may be, typically by that point, the portfolio is large enough that the dividend on a diversified stock portfolio is about 95%. So you just start using the dividend instead of reinvesting the dividend, and you don't need you may need to sell off a 0.5% or maybe even 1% a year of the portfolio to maintain your cash flow. I'm not a huge fan of that idea, only because I think it's messy, and I don't ever want to be put, because the other side of that is also the emotional side of it, because now the portfolio is going to be could be very volatile, even though the dividend tends to be fairly stable. The dividend is enough to meet most of your goal, and you don't need to sell very much of the stock to be able to maintain your overall, spending needs. I don't particularly care to do that. I'm always looking to value average. I don't like getting it, and it's more from the emotional standpoint than the financial standpoint. I don't want to be in year 15, 16 and see the market go down by 20, 30%, even though I'm okay, selling maybe 1% to maintain my cash flow, getting the dividend. I just don't like the way it feels. And I don't want to be in a position that makes me feel tight, anxious, upset, worried. Pick your adjective there. I don't like that. I want to be able to say that. And so I'm always looking for better than expected returns to maintain that time horizon, or at least some time horizon, so that Murphy's Law is my life. I am Murphy's Law incarnate. And if it's going to go wrong, it's going to go wrong here. And I just don't want to put myself or anybody I know in that position that screws it up.
I've heard that scenario brought up among people who, when we did our basic buckets thing a couple weeks ago, just the example, and you wouldn't do that in almost
I don't
any
care
case.
for it. Other people are okay with it.
Yeah, but I've heard that where they say, okay, well, you spend bucket 1 all the way down, you take bucket 2, you refill bucket 1, you spend that all the way down. It's been 15 years, and the market, 2 days before that or whatever, is down
just
30%.
Before you need, just before your last safe dollar is spent, the market goes down 20%.
Right, so your $1.5 million or whatever is down.
Turns into $1.2 million.
Right. So we try. There is an avoidance of that. I just wanted to make it clear when we talk about risk that we're not saying there is zero risk over 15 years, but historically, there has not been a 15-year period of time where stocks.
Correct.
Was it a 15 years?
15 years.
Yeah, where stocks did not beat. Was it T-bills? I'm saying that wrong, I think.
Well, that's a different one. That was Burt Malkiel's, I believe.
Oh, right.
And back after the 72, 73 bear market, it took 12.8, 12.6, something like that, years for the stock market to create a return average equal to what you would have gotten in safety, risk-free investments, T-bills. So if I'm not even getting what safety is giving me, why am I taking the risk? So you want to have, at that point, it was 12.8 years. And then we went through the dot-com bust, and the recovery was just in the market results. Don't forget, comparing it to safety was basically almost 10 years. And so we want a better than 10, 12-year time horizon, or why even take the risk?
Now, quickly, because
I will correct one thing there. In the 172, 73, when it says you had to get 12.8 years, 12.6 years to get the risk-free rate of return, remember what the risk-free rate of return was back through the late 70s, early 80s. T-bills were paying a little more than they are now.
I remember 12% somewhere is what they were paying, about 1980.
I think it might have gotten to 14 even at one point.
It may have. I remember at the bank seeing that. Even then, I thought, that's pretty good. I wouldn't mind sticking some money in that. But I digress on that. So very quickly, because we don't have a lot of time left, but if somebody did happen yes?
17.31% was the highest T-bill rate hit in 1981.
Like the very okay.
3 months.
Okay. That's 17?
Oh, that was a 1 year. I'm sorry. A 1 year treasury hit 17.31% in 1981. The 3 year hit 16%. Holy cow.
3 year hit 16%?
Excuse me, 3 month. The short one hit in 1981.
I didn't think it was the shortest one. I do, now that you mentioned, I do remember
3 months
talking
is
about
pretty
that.
short.
Well, it is, but the 1 year was higher at 17%, you said, right?
Yeah.
Yeah. Wow. So I lost. Sorry
for interrupting like that.
Okay, so if
we're doing this on the fly.
Well, hey, there's no script here, folks. Okay, so to wrap this up again, because TikTok here, we're running out of time. If somebody had a 30% stock, 70%, bond or whatever allocation, and used kind of a bucket strategy rather than a systematic withdrawal, I'm not sure you wouldn't have a problem with that. I don't think, would you? It's more the withdrawal
on day
method.
One.
Yeah,
you're talking about 70.
Well, no. Let's say they did that from. Let's say they just did that.
Well, the problem is I don't want them constantly rebalancing it. To the same allocation. That's the problem. Yeah. And so it's okay. So if I'm starting off and I've got 35% bucket 1, 35% bucket number 2, which leaves me 30% in bucket number 3, by the very nature, I'm drawing down bucket number 1. I'm spending that first 35%. So by sheer math, the 35% in bucket 2 and the 30% in bucket number 3 is going to grow. It's going to grow to a different number. I'm going to strategically value average, but I don't necessarily need to go back to a 35, 35, 30 when I'm 15 years into this, 80 years old, because I'm no longer looking to fund 30 years worth of cash flow. Maybe I'm looking to fund 15 years worth of cash flow. So I might want to say, you know what? I need the ability to spend more, but I don't need to. So I could actually have a higher. Maybe I go to a 30, 30, 40 at that point. But that's not saying that 30, 30, 40 is what every 80-year-old should have. That's what the target dates are saying. I'm saying let's look at your spending, and let's let your spending dictate what goes into stocks.
Not the other way around.
No.
Don't let dictate
stocks,
your spending.
Yeah. Don't let risk dictate what you spend. Don't let the market determine that you get a raise this year, or you have to cut way back and tell your creditors, sorry, catch me next month, catch me next year.
Right. So to put this all in a nutshell here, the idea that you should automatically own fewer and fewer stocks as you get older sounds logical when you really don't give it any thought. And that's why we said is the idea behind target date funds and why they've exist. But as I said here, you and I both said this here at the top of the episode, volatility is not risk. The risk of stocks happens because you got to sell in order to fund your short-term need. Or as I said, you panicked and you think, I can't handle this anymore. That's the emotional side of it. So, but when you structure a portfolio around time horizons, and that's what the bucket strategy is designed to do, as everybody knows who listens, everything looks a lot different. As your safer assets are spent down, the percentage of stocks in the portfolio by default tends to rise rather than fall. But does that mean you're taking more risk? Well, no. It just means you're organizing your portfolio so that the volatility of the stocks doesn't interfere with the cash flow you need today, while still giving these long-term assets time to do what they're supposed to do. Is that about...
You're taking control over the volatility instead of letting volatility control you.
Boom. Love it. You want to talk through how that might apply to your own situation? You can reach out to the advisors at Lucia Capital Group. Phone number there, I have it here, 800-644-1150. Again, 800-644-1150. Professor Rick Plum heads up the financial planning department. And, of course, they talk with their clients about this kind of stuff all the time, portfolio structure conversations. So don't forget, you can also visit the website, luciacap.com, LUCIACAP.com. While you're there, of course, check out the downloadable guides we have available. I talked about the buckets one last week, but we got a ton of them over there. Bucket strategy, estate planning, Social Security. Just go to the search bar in the upper right corner and you'll find guides on retirement income planning as well. And rollovers, too. We talked about that not too long ago. So check it out, free to download, and you can just read it and enjoy it. Don't forget to subscribe to the podcast so you don't miss future episodes. Find Managing Your Financial Future on Apple Podcasts and Spotify. Subscribing, make sure each new episode shows up automatically in your feed. That's a very important thing. Out of time for this week for Professor Rick Plum, certified financial planner professional and accredited wealth management advisor. I'm your podcast host, Johnny Dean. Thanks so much for listening. Managing Your Financial Future. We'll talk to you all again next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice, and its accuracy cannot be guaranteed. There is no guarantee that any investment strategy will meet its stated objective. All investments involve risk, including potential loss of principal. An asset allocation strategy does not ensure a profit or protect against loss. A dollar-cost averaging strategy does not guarantee a profit or protection from loss. Since such an investment plan involves continual investment in securities regardless of fluctuating price levels, you must consider your willingness to continue purchasing during periods of high or low price levels. A value averaging strategy does not guarantee a profit or protection from loss. You must consider your willingness to continue purchasing during periods of high or low price levels. There is no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. A diversification does not protect against market risk. Rebalancing a portfolio may cause investors to incur tax liabilities and or transaction costs and does not assure a profit or protect against a loss. 401k benefits may be subject to change at your employer, the governing pension, or benefit organization's discretion. A plan participant leaving an employer typically has 4 options and may engage in a combination of these options. So leave the money in their former employer's plan if permitted. 2, roll over the assets to their new employer's plan if one is available and rollovers are permitted. 3, roll over to an IRA. Or 4, cash out the account value. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Stock investing includes risks, including fluctuating prices and loss of principal. Bonds are subject to market and interest rate risk if sold prior to maturity. Bond values will decline as interest rates rise. Bonds are subject to availability, change in price, call features, and credit risk. Bond yields are subject to change. Certain call or special redemption features may exist which could impact yield. Annuity protection guarantees are based on the claims paying ability of the issuing insurance company. Before investing, carefully consider a target date fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. Treasury securities are backed by full faith and credit of the U.S. government but are subject to inflation risk. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC. LPL Financial Insurance License Number 0518721. LPLIA Insurance License Number 0B91442.